We are diving deep into a fascinating and I think a really massive economic puzzle today. It all centers on the Chinese yuan, the renminbi, and its big ambition to become a true global reserve currency.
It really is one of the central paradoxes of the modern global economy. I mean, you have an economy that represents a staggering 18% of world GDP.
18%, it's an absolute
It's a
powerhouse.
powerhouse of global manufacturing, of trade. And yet, when you look at how much of the world's official money, its reserves, is actually held in yuan, the number is, well, it's tiny.
That's the part that is just baffling to me. The yuan only accounts for what, 2.2% of global reserves right now?
That's right. And it's actually down from its peak around
So
2.8%.
2.2%. You compare that to the US dollar, which is still holding strong, around 57%. And it's not for lack of trying on China's part. They've launched the digital yuan, they've built CIPS for payments, signed all these currency deals. So why is the gap still so enormous?
It's tempting to look for really complex geopolitical reasons, but the core answer is much simpler and much more rigid. It's an inescapable economic law, proven correct again and again since the 1960s. We're talking about the impossible Trinity.
Also called the Mundell-Fleming trilemma.
Exactly.
I think this concept is maybe the single most important idea for understanding modern central banking. It forces you to confront the fact that policymakers, even in a state-controlled economy, can't just have everything they want. There are these ironclad zero-sum trade-offs.
And our mission in this deep dive is to really understand the gravity of that three-way trap. We're going to argue that China's policy choice, the one they made decisively a few years ago, means that 2.2% isn't just a temporary dip. It's a structural, self-imposed ceiling.
A ceiling they can't break through without, what, fundamentally changing their entire economic model.
Precisely.
Okay, let's unpack this constraint. What are the three desirable policy goals that the impossible Trinity says you absolutely cannot have at the same time?
So you can only choose two of these three. First, a fixed or managed exchange rate. That's all about stability.
Predictability.
Right. Second, free capital movement. So total openness for money to flow in and out.
Yeah.
And third, an independent monetary policy, which means you control your own domestic interest rates.
And you literally cannot have all three. Let's run that thought experiment we talked about, specific to China, just to show how this mechanism works. So let's say the PBOC wants to stimulate its slowing economy. They decide to cut interest rates. That's them using their independent monetary policy.
Okay. Now, imagine they also had free capital movement. What happens immediately?
Well, investors all over the world see the lower rates in China,
The lower yield on the yuan.
and they start selling it to buy higher yielding assets like US dollars or European bonds. It's classic capital flight.
Massive capital flight. And the moment everyone starts selling the yuan, its value starts to plummet.
So if the PBOC wants to maintain its managed exchange rate, prevent a currency crash, they have to step in.
They have to intervene. And
Yeah.
what's their only defense?
They have to sell their stash of foreign currency, their US treasuries.
Exactly. They sell their U.S. Treasury holdings, and they buy back all that depreciating yuan. But here's the critical part. The act of selling reserves and buying back your own currency is a contractionary monetary policy. It sucks liquidity right out of your own system.
So the first move to stimulate the economy is completely canceled out by the second move to defend the currency. The stimulus just evaporates. It's a closed-loop trap.
It is. The conflict is inherent. The goals literally fight each other when capital is free to move.
And when we look around the world, you can see the major economies making very different choices here.
Yes, very distinct choices. The obvious one is the United States. They chose free capital flows and an independent monetary policy.
And what did they give up?
A fixed exchange rate. They accept that the dollar has to float freely, that it can be volatile. That's the trade-off.
Then you have the fascinating Hong Kong model. They chose free capital and a fixed peg to the dollar. So they sacrificed.
Their entire monetary independence. The most dramatic example of this was during the 1997 Asian financial crisis. To defend that peg, Hong Kong's overnight interbank rates briefly soared to a staggering 280%.
280%? That's domestic chaos.
Absolute chaos. But the currency board's mechanism was automatic. It had to defend the peg, and the government couldn't step in to lower those rates.
Which brings us directly to the China model. Beijing has made it crystal clear. They need a managed exchange rate for stability, and they need an independent monetary policy to steer their economy.
So the trilemma dictates they must sacrifice the third leg, They have to have capital controls.
It's not just a policy preference, it's a mathematical necessity for their system to work.
And that necessity is what fundamentally blocks their global reserve ambitions.
Okay, let's pivot to that. Why is openness so foundational for a reserve currency? It sounds abstract, but for a global investor, it's the difference between safety and, well, entrapment.
Global central banks, sovereign wealth funds,
Yeah.
they all operate with crisis scenarios in mind. I need three things. One, the currency has to be a reliable store of value. That means free convertibility. Guaranteed repatriation,
You have to know you can get your money out.
always. Second, you need deep, liquid markets. If you need to sell, say, $50 billion worth of bonds tomorrow, you have to know the market won't collapse under the sale. And third, you need the deep infrastructure to handle those flows.
You can just see the US dollar's dominance here. The US Treasury market is over $30 trillion. And it operates on a principle of just absolute openness. Foreign investors own about 30% of that debt. That's $8.5 trillion.
And they trust, implicitly, that they can exit instantly if they need to. The comparison to China is just, it's stark. Foreign ownership of Chinese bonds is only 2.7%.
Only 2.7. That's lower than most emerging markets.
Way lower. Typical emerging markets are 10 to 25%. Even a highly developed economy like Japan is 12 to 14%. That 2.7% figure, it's the numerical proof of the trust deficit created by capital controls.
Because if I'm a European central bank holding yuan, I need to know I have guaranteed rapid access in an emergency. If I suspect that capital controls might get slammed shut during a panic, I simply won't hold the asset in the first place.
You won't. And history confirms this rule. Just look at the decline of the British pound after World War II. Sterling's share of global reserves fell from 81% in 1945 all the way down to 11% by 1970. And that decline accelerated precisely because the UK imposed extensive exchange controls. It signaled to the world that the pound was no longer a reliable safe haven.
Which brings us to the dramatic, real-world test of this whole theory, the 2015-2016 crisis in China. This was the moment they tried to open the door a little, saw the consequences, and immediately slammed it shut.
It was the defining moment for their current policy. In August 2015, the PBOC devalued the yuan by 1.9%. It was intended as a market-driven reform, but markets, which were already nervous about slowing growth, took it as a sign of desperation.
The panic was immediate. The Shanghai Composite dropped 30%, and then the great capital exodus began.
The scale of the capital flight was just staggering. We're talking about approximately $1 trillion fleeing China in less than 2 years.
$1 trillion.
And this wasn't just, cash in suitcases. Our sources indicate it flowed through really sophisticated mechanisms. Things like the over-invoicing of imports, which apparently accounted for over 70% of the recorded decline in reserves.
So the PBOC was forced to defend the currency to stop a complete collapse, which means they were just burning through their reserves at an incredible rate.
They burned through nearly $1 trillion in foreign reserves. They went from a peak of $4 trillion down to under $3 trillion by early 2017. That loss rate was an institutional trauma. It showed them that if they continued this liberalization experiment, they were facing an existential threat to their financial stability.
Wait, hold on. $1 trillion gone in under 2 years. That kind of hemorrhaging must have fundamentally altered Beijing's worldview. It stopped being an economic policy debate and became a national security issue.
It did. The lesson was articulated very clearly later on. One source from a central banking journal put it this way: the authorities realized they erred by opening the capital account more quickly than warranted. They're unlikely to repeat that mistake. The door to liberalization wasn't just shut, it was bolted. Control won the argument decisively.
So let's look at what that control architecture actually looks like today. Because it's not just one single wall, it's this massive overlapping set of restraints.
It is. And for individuals, it starts with what's called the facilitation quota. Each Chinese citizen is restricted to exchanging only $50,000 per year.
And since 2017, it's not just a limit, right?
Yeah.
They demand justification.
That's correct. You now need to fill out detailed applications specifying the purpose of the purchase. And the rules explicitly forbid you from using that money to buy foreign property, foreign securities, or certain insurance products.
And they actively police this. I love the term they use for tracking people who try to get around the limits.
The ants moving enforcement strategy, it's aptly named. Regulators track families or groups who split up transactions across multiple individual quotas to sneak more money out. If you're caught, you get put on a watch list, and your forex quota is likely suspended.
It just shows the incredible detail of the restraint, and for big companies, it's even tighter.
Absolutely. The main currency watchdog, SAFE, can halt any large outward direct investment project over $50 million if it's in a restricted category like foreign real estate or sports clubs. They demand a whole gauntlet of bureaucracy to ensure the money is for productive investment, not just capital flight in disguise.
Even foreign investors who are invited in are kept in this highly regulated, closed system, right? Like Stock Connect and Bond Connect.
Those channels are the very definition of controlled access. They have specific daily net buy limits and aggregate foreign ownership caps, usually around 30% for a single company. It ensures that while foreign money can come in, it can't overwhelm the domestic system or, crucially, flood out all at once.
And finally, the currency itself isn't allowed to float freely. The PBOC sets a daily rate, but they also have that opaque tool, the countercyclical factor.
Yes, the CCF. It's essentially a thumb on the scale, an adjustment to market makers' quotes that lets the PBOC steer the yuan's value, especially when there's pressure for it to depreciate. It's definitive proof of active management.
So, if the controls are so tight, why doesn't Beijing just liberalize? Surely they understand the impossible Trinity. They know what they would need to do.
Oh, they do. But they are caught in what the economist Michael Pettis calls a deep structural trap. China's whole growth model for decades was built on financial repression.
Meaning what exactly?
It means holding interest rates artificially low, often 500 to 800 basis points below what a free market would set to provide cheap capital to state-owned enterprises and subsidize investment. And this comes at the direct expense of household savers.
And if they liberalized fully, those households whose money is currently locked into these terrible returns would immediately try to move their cash abroad.
It would be a catastrophe. That's the risk they fear. Sources estimate that full liberalization could trigger gross portfolio outflows of between $2.7 and $4.5 trillion over 5 years.
Trillion, with a T.
Trillion. That is more than enough to deplete their reserves entirely, collapse the currency, and cause a massive financial crisis. Liberalization would impose a level of market discipline that fundamentally challenges the state's entire model of capital allocation.
And beyond the pure economics, there's the issue of institutional trust. This is where S. Prasad's work is so insightful.
Prasad argues that to be a true safe haven currency, you need these non-economic pillars. You need an independent central bank, the rule of law, and institutionalized checks and balances. These are the institutions that provide the deep underlying trust. And he observes that China is, quote, showing no indication of moving in that direction.
So despite all the genuine achievements, and they are real achievements, like CIPS processing over $24 trillion last year, or the digital yuan projects, the core problem of the impossible Trinity remains this structural blockade.
The digital infrastructure, the payment pipes, they're impressive. But they are not a substitute for financial openness and trust. Even the Federal Reserve concluded this past year that yuan internationalization shows signs of stalling out. They noted that the yuan share of global reserves has actually declined from its 2.8% peak back down to 2.2. Infrastructure alone isn't enough.
So what does this all mean for the future? What is the final choice that they've made?
China has chosen financial stability and absolute domestic control over the requirements of becoming a dollar rival. The impossible Trinity dictates this trade-off, and the trauma of 2015-2016 cemented that decision.
So that structural barrier is the ultimate constraint. The conclusion we're drawing from this deep dive is pretty sharp then. That 2.2% reserve share isn't temporary, it's the structural ceiling imposed by their own policy choices.
It is. The yuan will remain a powerful regional currency for trade settlement, but it's nowhere close to being a true global reserve currency. Currency status follows institutional credibility and openness. You can't manufacture it through control.
So let me leave you with this final provocative thought. Our whole analysis assumes a single integrated global financial system. But what happens if other nations, forced by geopolitics or sanctions, start adopting controlled Chinese infrastructure like CIPS, despite the lack of full convertibility? Does that lead not to a single rival, but to separate controlled regional currency zones, a fractured world?
That implication of financial worlds split into different blocks with different rules is a very real possibility.
Absolutely. And next time, we will take a deep dive into CIPS versus SWIFT. But now you understand why the pipes alone are never enough.